Section 4. Endogenous Policy Credibility Model, ENDOCRED, adding non-linearities and layers of complexity. ENDOCRED is not a production model, but a thinking device enabling policymakers to explore alternative scenarios and refine judgments in production processes. For instance, it helps central bankers understand how inflation premiums in sticky prices and wages persist, even when financial market expectations remain anchored, ensuring that policies are calibrated to address these dynamics effectively. This paper demonstrates how models like ENDOCRED complement linear production models by addressing the persistence of inflation premiums and the dynamic nature of credibility. The prudent risk management approach, rooted in the lessons of 2021 and the insights of critics like Summers, offers a robust framework for managing uncertainty and enhancing policy effectiveness. 1. The Convex Phillips curve. The first modification to the canonical model is introducing a convex Phillips curve, reflecting the nonlinear relationship between inflation and unemployment. Macklem, 1997, provides an in-depth review of the origins of this convexity, highlighting the nonlinear relationship between economic activity and inflation, and emphasizing that capacity constraints make inflation more sensitive to positive output gaps than negative ones. This convexity in the Phillips curve suggests that proactive and measured monetary policy is crucial to prevent significant economic imbalances and control inflation effectively. Recent work by Forbes, Gagnon, and Collins, 2021, establishes that the Phillips curve exhibits significant nonlinearity, where inflation is largely unresponsive to economic slack in low inflation environments due to downward wage and price rigidity, but becomes markedly steeper in high inflation regimes or when output surpasses potential, reflecting stronger inflationary pressures. Benigno and Egertson, 2023, show that inflation in the 2020s was driven by tight labor markets, with steep inflation responses to low unemployment and minimal effects from wage rigidity at high unemployment levels. Their findings emphasize that anchored inflation expectations and appropriate monetary policy can lower inflation without triggering a severe recession, contrasting with past periods like the 1970s. The model employs a convex inflation expectations augmented Phillips curve, illustrated in Figure 4, where its convex shape comes from the non-linear output gap term. As the output gap gets closer and closer to its maximum value, the slope of the Phillips curve gets steeper. The IMAX parameter follows the logic of the relationship between the output and unemployment gap set forth by Okun's law, in that a high output gap results in an unsustainably low unemployment gap. This is represented by the right part of the curve where the dark corner and high and variable inflation prevail, as infamously highlighted by Blanchard, 2014. To describe the asymptotic region of the curve, we like the disaggregated approach taken by Evans, which describes how bottlenecks, sectors where firms operate at full capacity, cause aggregate supply to become progressively less elastic as demand increases. As more sectors reach capacity limits with labor becoming fully employed, wages adjust flexibly to clear the market. The aggregate supply curve steepens, eventually leading to inflation without further output gains. This conceptual approach is useful to connect the anecdotal information about labor shortages during the pandemic with the steepening of the Phillips curve, which some economists use to explain part of the recent surge in inflation. Summers, 2021, and Blanchard, 2021, argued against the notion that pandemic-era inflation would be transitory, emphasizing that unprecedented fiscal and monetary stimulus could push the economy into the steeper region of the Phillips curve. In this scenario, tight labor markets would amplify wage and price pressures, potentially leading to persistent inflation. They warned of risks like denatured inflation expectations and a wage-price spiral. Blanchard and Bernanke, 2023, revisit this debate, acknowledging that while labor market overheating eventually contributed to persistent inflation, the initial surge was primarily driven by product market shocks, such as commodity price increases and supply chain disruptions. They highlight that these factors were underestimated in early inflation forecasts. The 1970s U.S. economy is an example of a dark corner with high and variable inflation coupled with high unemployment, a phenomenon known as stagflation. Driven by oil shocks, monetary policy missteps, and the collapse of the Bretton Woods system, economy inflation reached to double digits, later requiring sharp and painful disinflationary measures. The middle region of the curve, where output gap is close to zero, represents the linear space and is best characterized by the Great Moderation era from the mid-1980s until the GFC, where the output-inflation trade-off was modest and well-behaved. The left side of Figure 4 represents the dark corner where high unemployment and deflationary forces dominate. In this region, the Phillips curve is relatively flat based on the effects of downward wage and price rigidities. Forbes, K, Gagnon, J, and Collins, C, 2021, as well as the hysteresis effects described by Blanchard and Summers, 1986. A notable example of when this environment prevailed was the post-global financial crisis, GFC period, where it took policymakers several years to escape a low inflation trap. In some cases, such as in the euro area, these deflationary pressures persisted into the pandemic. Hysteresis, as described by Blanchard and Summers, 1986, highlights how temporary shocks to unemployment can have lasting impacts on the economy, eroding the economy's productive potential through mechanisms like skill loss, capital deterioration, and labor market dynamics favoring insiders over outsiders. These persistent effects make it imperative to adopt models that go beyond linear approximations. DeBell and Laxton, 1997, emphasized the role of monetary policy to provide a buffer zone to guard against excessive economic variability, especially in a world where hysteresis effects may arise. Building on Laxton, Meredith, and Rose, 1994, Clark, Laxton, and Rose, 1996, Turner, 1995, they support the existence of asymmetries in the Phillips curve, advocating for models that incorporate inherent nonlinearities, such as a convex Phillips curve, to better represent the real-world dynamics of inflation and output. Additionally, Laxton, Rose, and Tambakis, 1999, argue that the costs will be higher if policymakers assume linearity when in fact it is convex. If the Phillips curve is linear, positive and negative demand shocks will have equal effects on inflation. Additionally, the timing of monetary policy responses becomes less important, giving central banks little motivation to act early against inflationary pressures and more reason to delay. In contrast, in the case of a convex Phillips curve, inflation rises disproportionately faster from positive demand shocks than it declines in response to equivalent negative demand shocks. This makes early action against rising inflation critical to avoid larger problems later. By acting promptly, central banks can reduce the need for more extreme measures in the future and stabilize employment levels, thereby lowering the average unemployment rate over time. Therefore, in a convex world, a prudent risk management approach to monetary policy aims to prevent significant cyclical imbalances. Small steps to test the limits of an economy's capacity, such as allowing moderate inflationary pressure, are relatively low risk. However, large mistakes like letting the economy overheat significantly can lead to steep costs in terms of higher inflation, economic instability, and the need for severe corrective measures. 2. Uncovered interest rate parity, shock absorbers, and amplifiers. To explore the dynamics of exchange rates and interest rates in different monetary policy regimes, we derive a multi-period uncovered interest rate parity (UIP) condition. This derivation provides a framework for analyzing how exchange rate and interest rate movements interact with the monetary transmission mechanism. Depending on the credibility of the central bank and the prevailing economic conditions, these variables can act as either shock absorbers or shock amplifiers. Figure 7. During normal times when economic stability prevails, exchange rates and interest rates generally function as stabilizing forces, absorbing shocks and mitigating their impact. However, the role of credibility becomes especially crucial during periods of economic turbulence filled with heightened economic uncertainty. When the economy enters the dark corners of either high and variable inflation or a low inflation trap, the central bank's credibility is tested to its full extent. In such turbulent times, credibility determines whether exchange rates and interest rates continue to act as stabilizing shock absorbers or instead amplify shocks, exacerbating economic volatility and deepening instability. Recognizing the importance of these dynamics, we begin by introducing the standard one-period risk-adjusted UIP condition. Real exchange rate as a shock absorber. Under normal circumstances, with an active monetary policy, a negative demand shock leads to a reduction in inflation in the short run, while the long-run real exchange rate remains unaffected. In response, an inflation-targeting central bank typically lowers the policy rate to stimulate the economy and to bring inflation back to target. According to the UIP condition, This rate cut leads to an immediate depreciation of the currency. The spot exchange rate must rise to offset the anticipated decline in future interest rates. Or in other words, in a credible policy regime, medium-term inflation expectations would rise and real interest rates would decline more than nominal rates. At the effective lower bound, ELB, while the nominal rate cannot fall further, expectations of prolonged ELB conditions and higher inflation would lead to a reduction in real interest rates. Thus, in case of normal times, as well as during ELB with an active credible policy, we have. As a result, the real exchange rate will depreciate given that long-run real exchange rate, expected trajectory for real foreign interest rate along with risk premium, as well as disturbance term remain unaffected. This depreciation boosts demand by stimulating exports and encouraging a shift in expenditure from foreign goods to domestic goods. Real exchange rate as a shock amplifier. At the ELB, the exchange rate can exacerbate the effects of a shock. If the policy response is passive and lacks credibility, a negative demand shock would lead expectations of lower inflation in the future. This could cause both current and anticipated short-term real interest rates to rise, resulting in a real appreciation of the currency. The appreciation exacerbates the recession. To analyze the real-world implications of the ENDOCRED model, we apply it to a two-country framework focusing on the United States and the Eurozone during the early stages of the COVID-19 pandemic. Using the multi-period risk-adjusted uncovered interest parity (UIP) condition, we examine how credibility, or the lack of it, shaped the monetary transmission mechanism, particularly through the behavior of exchange rates and interest rates. The model highlights how these variables acted as shock absorbers for the U.S. economy, supported by a credible central bank, while they functioned as shock amplifiers in the Eurozone, where credibility was weaker during this period. This dynamic underscores the importance of central bank credibility in ensuring the smooth functioning of the transmission mechanism and avoiding macroeconomic instability, particularly in times of heightened economic uncertainty. The two-country setup distinguishes between U.S. monetary policy modeled with a loss function and Euro area monetary policy, represented by a canonical inflation forecast-based reaction function. While these approaches are not exact replicas, they reflect the historical behavioral differences between the Federal Reserve and the European Central Bank, ECB. During the pandemic, these differences were evident as the Eurozone struggled with a low inflation trap, with inflation expectations significantly below its target, while in contrast, inflation expectations in the U.S. remained relatively well anchored, Figure 8. This two-country analysis highlights the importance of credibility in maintaining effective monetary policy and exchange rate stability. As the pandemic progressed, inflation expectations ratcheted downwards in both countries from the uncertainty presented by the lockdown policies, which not only hit the supply side of the economy, but also demand, lowering inflation in the short run. Normally, under these circumstances, an inflation forecast targeting central bank would be expected to reduce the policy rate, and the exchange rate would depreciate and act as a shock absorber to help eliminate the output gap and steer inflation back to the target, as depicted in a standard nominal UIP equation where S is the nominal exchange rate. However, since it was a globally synchronized shock, central banks around the world were cutting interest rates to stimulate their economies. Yet, the ECB was handicapped with rates at the effective lower bound. As inflation expectations ratcheted down and nowhere for nominal interest rates to go, real interest rates would naturally rise and apply appreciation pressure on the exchange rate, equations 17.2, 18, and figure 9. 3. Adding a loss function for monetary policy with asymmetric preferences to overheating. In the model, we have an option for monetary policy that is represented by a loss function that penalizes squared deviations of negative output gap only, inflation from the target, changes in the policy rate, and the price level gap. The term RO represents the discount rate. The weights embody the costs that policymakers attach to each of these items. Monetary policy minimizes this loss function, subject to the constraints imposed by the structure of the model. Monetary policy has choices with respect to the speed at which inflation returns to the target. This may be faster if the cost of missing the inflation target is high relative to the costs of output gaps and interest rate volatility. Or it may be slower if the cost of inflation targeting errors is relatively low, such as when long-term inflation expectations are well anchored and there is a high degree of confidence in the inflation targeting regime. The quadratic loss function implies symmetric aversion to overshoots and undershoots with respect to the inflation target and potential output. However, one might argue that policymakers' preferences would not be symmetrical. In this case, it is possible to restrict the loss function to only recognize undershoots and not overshoots, and vice versa. In fact, our calibration of the loss function for the U.S. only responds to negative output gaps and not positive gaps, reflecting a view that the Fed is more tolerant of overheating than cooling in the real economy. 4. Constructing central bank credibility. Standard linear models typically assume that central banks have perfect credibility, but periods of high or persistent inflation reveal that this assumption is often unrealistic. Understanding this discrepancy is essential because central bank credibility hinges on the extent to which medium and long-term inflation expectations remain anchored. When medium-term expectations deviate persistently from the inflation target, credibility erodes, leading to higher long-term inflation expectations and shifts in wage and price-setting behaviors that align with those expectations. In extreme cases, such as when inflation uncertainty becomes particularly severe, agents may opt to price major goods and services, including housing, in foreign currency, a phenomenon known as dollarization. Credibility influences inflation expectations by determining the weight placed on past versus forward-looking information. In scenarios of lower credibility, greater weight is placed on past inflation data, with the forward-looking component receiving less emphasis. This contrasts with models that assume perfect credibility, where expectations are largely forward-looking and reflect the central bank's policy goals. The inclusion of credibility in the ENDOCRED model allows for a time-varying process in the evolution of inflation expectations, unlike the canonical model where these parameters are fixed. Under ideal conditions of perfect credibility, expectations should be fully forward-looking and model-consistent, aligning with the central bank's policy assumptions. In an imperfect credibility scenario, however, agents tend to extrapolate from past outcomes, leading to a greater reliance on backward-looking expectations. Even in highly credible environments, backward-looking elements may still persist, making inflation expectations empirically challenging to model. Blanchard and Bernanke, 2023, provide an important case study of inflation dynamics using a backward-looking specification for inflation expectations. Their model, however, does not incorporate monetary policy or consider the role of expectations in guiding policy decisions, which limits its direct applicability to policy analysis. In contrast, the ENDOCRED model integrates both retrospective ex post and prospective ex ante expectations, making it more suitable for understanding the interplay between inflation expectations and policy actions. This approach mirrors firms' pricing strategies, which combine past trends with future projections over an annual horizon. While measuring inflation expectations remains a complex task, the ENDOCRED framework offers a basis for understanding the formation of both backward and forward-looking expectations, and provides a foundation for addressing issues of risk management in policy contexts. The first two terms in the inflation expectations equation comprise a weighted average of a model-consistent forecast of the 4-quarter ahead year-on-year inflation rate and the year-on-year inflation rate observed last quarter. Additionally, the employment of credibility removes the fixed parameters in the canonical model and replaces it with our measure of the stock of credibility, which ranges between 0, no credibility, and 1, full credibility, and can change over time. When credibility is imperfect, falls below 1, two key processes come into play. First, existing inflation becomes more persistent, as reflected in the coefficient of the backward-looking component in expectations. Second, inflation expectations can adjust upward or downward depending on whether the economy is in a high or low inflation regime, driven by the inflation bias that emerges within these regimes. We define two distinct inflationary regimes to illustrate public expectations and their implications using subjective probability distributions. The first is a high inflationary regime, characterized by public skepticism that inflation will converge to the central bank's target, instead anticipating a significantly higher level. For illustrative purposes, we assume an inflation level of 5%, not as an empirical estimate but as a benchmark to capture the dynamics and risks of such a scenario, akin to the concerns of the 1970s. If inflation expectations were to rise to 5%, then the probability of being in a high inflation regime would be 100%, and central bank credibility would be 0 as a result. The second regime is a low inflationary scenario, reflecting public belief that inflation will fall well below the target, potentially resulting in a low inflation trap. Here we adopt a level of -1% to account for the dark corner of low inflation described by Blanchard, which highlights the risks of deflationary pressures. This means that if inflation expectations were to fall to -1%, we would interpret this as a 100% probability of being in a low inflation regime, with central bank credibility reduced to zero. These illustrative benchmarks help conceptualize the formation of inflation expectations and the divergence of public sentiment in high and low inflation environments. This framework allows economists to define the relevant regimes based on their subjective assessments or values, while the methodology provides a versatile tool to explore inflation dynamics across different countries and alternative regimes. We take a simple probabilistic approach where the probability of being in a high or low inflation regime is denoted by prob high, prob low, respectively. Only one can exist at a time, and the higher the probability, the more it will bias inflation expectations away from the central bank target. We demonstrate the bias effect in inflation expectations when credibility declines by including a coefficient for the bias term, to capture this bias in the transition from perfect to imperfect credibility. Credibility is built gradually by consistently achieving stated goals. Conversely, it can be eroded quickly by actions that contradict announced objectives. There are three processes for shaping expectations. The first is optimistic but cautious, assigning weight to both the central bank's inflation target and past inflation, with a greater emphasis on the target as long as credibility remains high. The second is skeptical, reflecting historical experience and assuming inflation will revert to a high level while largely disregarding the central bank's target. Similarly, a third skeptical process exists, also rooted in historical patterns, but assumes inflation will revert to a low level and similarly gives little importance to the central bank's inflation target. When the actual inflation is less than the target, the probability of a high inflation regime is zero. Otherwise, we calculate the probability of being in a high inflation regime by dividing the squared deviation of expectations from the target by itself, plus the squared deviation of expectations from the high inflation regime. The forecast errors expected by optimists and skeptics will be the difference in actual observed inflation and their expectations. The forecast errors in this framework represent the deviations between actual inflation and the inflation levels people expect under their optimistic or skeptical scenarios. These errors adjust dynamically based on how closely actual inflation aligns with either the target or the extremes of the high or low inflation regimes. When actual inflation moves closer to the target and further away from the dark corners of high or low inflation regimes, the forecast error associated with optimistic expectations decreases. When actual inflation fully aligns with expectations under the optimistic scenario, target level inflation, the forecast error for optimistic expectations becomes zero. Mathematically, this implies that the numerator in the probability formula for either high or low inflation regimes becomes zero, leading to a probability of zero for being in those regimes. This reflects a situation where inflation expectations are perfectly anchored to the target. On the other hand, as actual inflation drifts away from the target and approaches the high or low inflation regimes, the dark corners, the forecast errors for skeptical expectations diminish. In the extreme case where actual inflation fully aligns with expectations under the high or low inflation regimes, the forecast errors in those regimes become zero. Mathematically, this eliminates the second term in the sum of the denominator, making it equal to the numerator of the fraction and resulting in a probability of 100% for being in either the high or low inflation regime. We use 10-year inflation expectations from the bond market and plot the historical inflation expectations and measures credibility, credflow for the US and Euro area from 2018. The main takeaway is that inflation was better anchored in the US heading into the pandemic, and therefore Fed credibility was close to perfect. Meanwhile, the Euro area was still mired in a persistently low inflation regime, with inflation expectations persistently below the ECB target and therefore entered the pandemic with imperfect credibility, Figure 5. A premature conclusion here would be that based on 10Y inflation expectations, central bank credibility in the US and the Euro area has been re-established. We would guard against such a conclusion. While it is remarkable how little the bond market has priced higher long-term inflation during the pandemic era, the situation in the US and the Euro area is hardly on solid ground. There are measures of underlying inflation that remain inconsistent with the 2% objective in both countries. Our preferred conceptual measure for underlying inflation would be the Atlanta Fed's measure of sticky price inflation. We believe its methodology to separate frequently adjusted prices, known as flexible prices, from infrequently set prices, known as sticky prices, offers superior insight. In this paradigm, sticky prices may tell us something about how price setters view the future when setting their prices. However, the euro area does not have flexible sticky price indices, so we just plot services inflation for both countries to maintain consistency, Figure 6. That said, we can sympathize with the Fed and the ECB's attempt to take advantage of these conditions in the bond market. It certainly looks like a case of the Fed using their perceived credibility capital to optimize policy and achieve a soft landing. However, they are playing a dangerous game when sticky service inflation has remained as persistent as it has where both economies are vulnerable to inflationary shocks while this status quo remains. This issue will be the subject of the scenarios we have prepared for the monetary policy outlook in the US and Euro area using the latest data in Section 7. Finally, we introduce the Central Bank Credibility Stock Index that evolves according to a standard stock accumulation process where the stock of credibility depends partly on its lag and partly on the signal from the bond market, as well as a disturbance term representing a shock to central bank credibility, which may be positive or negative. Cred stock then determines the weights on the backward and forward-looking components in the formation of inflation expectations equation, where higher levels of credibility lead to more forward-lookingness. Where kappa high greater than 0 biases inflation expectations higher, while kappa low lower than 0 biases inflation expectations lower. When cred stock is equal to 1, credibility is perfect, and inflation expectations become fully forward-looking and the inflation regime bias disappears. This reduces inflation persistence and ties inflation more tightly to the target, such that the central bank must do less in response to shocks, and convergence to the target rate is faster. The other extreme case when cred stock, kappa high and kappa low are equal to 0, then we get the original backward-looking specification for inflation expectations as in the canonical model. 5. Applying the two-country ENDOCRED model to the United States and Euro area. To illustrate the mechanics of ENDOCRED, we use this backdrop to calibrate the initial conditions for a simulation exercise in June 2020, Figure 10. Importantly, long-term inflation expectations had drifted down to 1.5% in the US and 0.8% in the euro area, reflecting the view at the time of the magnitude of the demand shock and the Fed and ECB's ability to manage it. For the purposes of the scenario, we set the respective inflation targets to these long-term inflation expectations values, while also setting initial credibility in the US at 0.9 and in the euro area at 0.7, reflecting Figure 5. To generate the scenario, we used a combination of demand and supply shocks. The dominate shock is a common negative aggregate demand shock to both countries that mirrored the effect of the pandemic lockdowns, where both aggregate demand and supply would have fallen, but demand by more than supply. We add some small deflationary shocks at the beginning to reflect these conditions as well. In the simulation, the Fed spends a long time at the ELB, but not as long as the ECB, and the reason for this is that the ECB enters the pandemic with lower levels of credibility since they allowed inflation expectations to ratchet downwards beforehand. The damage of this policy becomes evident when both the US and the euro area are hit by the same negative demand shock presented by the lockdown policies. In the case of the US with higher levels of credibility, the decline in the policy rate and extended period along the ELB is compelling enough for financial markets to expect inflation to return to levels that is more consistent with the Fed's 2% target. However, in the case of the euro area, no one believes the ECB is potent enough to respond to the shock, and so inflation and inflation expectations drift lower from a lack of credibility. This divergence in inflation outlook widens the expected price level between the US and the euro area, and the EUR/USD exchange rate appreciates, reinforcing the deflationary forces from the negative demand shock and needlessly prolonging the recovery in the euro area. This self-fulfilling outlook is reiterated by the ECB's own forecasts at the time presented in Figure 11, where inflation was expected to remain very low, 1.3%, for a few years. The simulation using ENDOCRED does not offer a solution to the ECB's problems during the pandemic. That question is the subject of the next section and requires a deeper discussion about the broader analytical framework of central banks that goes beyond any one model. However, what this exercise does show is that it could have been anticipated that the pandemic shock would lead to a breakdown in the ECB's transmission mechanism to deal with a globally synchronized demand shock given the relative starting position of the US and Euro area economies. Furthermore, having this understanding in hand could have triggered a need from the central bank to coordinate with fiscal authorities and work towards replacing the policy space missing from monetary policy with fiscal. In essence, if the ECB wanted to communicate a credible path for the recovery and avoid counterproductive movements in the exchange rate, then it would have needed to show how a more forceful fiscal response was required.